Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, May 25th, and the market menu has IPO hype, retail bonds, cooler inflation, oil anxiety, and billionaires shopping overseas like the global economy is a duty-free store.
Beautiful. Nothing says calm, middle-class morning like checking whether your portfolio, petrol bill, and retirement plan are all starring in the same disaster movie. But there are opportunities here if we separate signal from financial confetti.
Story 1. Bloomberg reports that Zepto, the Indian rapid commerce firm, is preparing to publicly file in early June for an IPO that may raise up to $1 billion. The simple version? Investors are being asked whether 10-minute grocery delivery is a growth engine or just a very expensive way to move bananas quickly.
I love convenience, but if a company delivers onions faster than I can find my keys, I ask, who is paying for the miracle? For normal investors, the key is not just revenue growth. Watch unit economics, customer retention, delivery costs, and whether discounts are doing the heavy lifting, like a gym bro with bad knees.
Exactly. IPOs often arrive dressed as opportunity, but the price matters. If you are an everyday investor, do not confuse a hot brand with a good entry point. A useful rule? Read the prospectus for cash burn, margin trend, and how insiders are selling or holding.
Tiny disagreement. I think brand heat does matter more than finance textbooks admit. Consumer habits can compound. But yes, if the prospectus looks like a bonfire with page numbers, maybe do not throw your vacation fund into it.
Story 2. SoftBank Group plans to raise 260 billion yen, about $1.6 billion, through subordinated bonds aimed mainly at individual investors. Translation: SoftBank is borrowing from the retail market again, and subordinated means these bondholders stand behind more senior creditors if trouble hits.
So it is like being invited to dinner, but you eat after the adults, the neighbors, and possibly the family dog. Higher yield can be tempting, especially for savers tired of low returns. But the yield is the market's way of whispering, please read the risk section, hero.
That is the core personal finance lesson. Bonds are not automatically safe just because they sound boring. Check issuer leverage, maturity, call features, currency exposure, and ranking in the capital structure. Income investing is still investing, not a coupon clipping spa day.
Story 3. Singapore reported April inflation below expectations. Headline inflation came in at 1.8%, while core inflation, excluding private transport and accommodation, was 1.4% versus estimates around 1.7%. That is not champagne time, but it is at least sparkling water time.
And Singapore also revised economic growth higher, which is the better combination: cooler price pressure with firmer activity. For households, slower inflation can ease budget stress. For investors, it can support consumer stocks, banks, and regional risk appetite, though 1 month of data is not a victory parade.
I will push back a little. Lower inflation is nice, but people do not live inside a spreadsheet. If rent, groceries, or school costs are still high, a 1.8% headline number can feel like being told the kitchen fire is now decorative lighting.
Fair correction. Inflation rates measure the speed of price increases, not whether prices went back down. Actionable takeaway? Keep emergency savings, review floating rate debt, and avoid assuming central banks will rush to cut rates just because one print came in soft.
Story 4. The Strait of Hormuz remains a giant question mark. The New York Times reports that without details of a formal agreement, it is unclear how soon normal shipping resumes and when oil prices start to come down. That waterway is not just geography. It is a global fuel price pressure point.
The finance behind it is simple. If a key shipping route is blocked or uncertain, traders price in supply risk. That can hit gasoline, diesel, airlines, chemicals, fertilizers, and food transport. Even if you never trade oil, oil may trade your monthly budget.
Story 5. The BBC reports Indian billionaires are buying foreign companies as growth slows at home. India Inc. spent $18 billion on global buyouts in 2025, and deal value could cross $15 billion in the first half of 2026. That is not window shopping. That is bringing a forklift to the mall.
This signals two things at once. First, Indian companies still have ambition and capital. Second, slower domestic growth can push firms to diversify abroad. For investors, watch whether acquisitions add technology, customers, and cash flow, or just produce heroic press releases and integration headaches.
Today's checklist. Treat IPOs as research projects, not lottery tickets. Read bond fine print before chasing yield. Use inflation data to adjust budgets, not emotions. Keep oil risk in your expense planning. And remember, when billionaires diversify globally, maybe your portfolio should not be one lonely basket with a motivational quote in real life.
That is BD Daily Finance News Podcast. If this helped, subscribe, like, and tell us in the comments which story affects your wallet most: IPOs, bonds, inflation, oil, or global deal-making. We will be back with more clear finance, fewer buzzwords, and only responsibly roasted market drama.